Dirty dealings, corporate battles, consumer woes. This is Evening 5. Nestlé Malaysia saw its net profit plunge 48% to 93.6 million for its second quarter, compared with 180.9 million a year ago. The decline was driven by a drop in domestic sales, reflecting subdued consumer sentiment and constrained purchasing power, according to Nestlé. Revenue for the quarter stood at 1.52 billion, 13% lower year-on-year compared with 1.75 billion previously. The group declared an interim dividend of 70 cents per share. Moving ahead, Nestlé expects the challenging conditions to remain throughout the third quarter and moderate progressively towards the end of the year, with a return to growth latest by the first half of 2025. For the first half of 2024, earnings fell 23.5% to 289.1 million due to subdued consumer sentiment and cautious spending observed during the Chinese New Year and Hari Raya festive seasons. Revenue for the first half came in at 3.31 billion, an 8% decline from the historically high record sales achieved for the first half of FY 2023 of 3.59 billion ringgit. CEO Juan Arenal said the group recognized the significant challenges that high food costs, driven by the global situation of commodity prices, create for Malaysian families. He said that this is why Nestlé will continue to make every possible effort to moderate the translation to its final prices of these external cost increases, absorbing them to the best of its ability and mitigating cost pressures through all possible actions, including improving the internal process efficiencies and the adoption of digital-enabled technologies across its entire value chain. Nestlé closed 0.16% higher at 122 ringgit today, valuing the company at 28.61 billion ringgit. A total of 3.4 million of the 13.1 million Employees Provident Fund members under the age of 55 have made withdrawals from the flexible account, amounting to 8.9 billion as of July 19, 2024. Finance Minister Tu Datuk Sri Amir Hamzah Azizan said that for the same period, a total of 3.8 million or 29.3% of EPF members choose to have the initial amount in the flexible account with a transfer of 12.6 billion, while 5.6 billion was transferred to the retirement account or account 1. He said the transfer to the retirement account increased members' savings, with the addition of 43,000 new members having reached the basic savings level. He said the withdrawals from the flexible account do not significantly impact the EPF, as the expected amount of withdrawals by members is within the EPF's cash and money market allocation. Regarding the implications for the national economy, Amir Hamzah said the initial estimate of the flexible account withdrawals in the first year was around 15 billion, or about 0.8% of Malaysia's nominal gross domestic product for 2023. Nevertheless, the actual impact of the introduction of flexible account on the country's GDP growth will depend on several factors, including the members' spending tendencies, according to Amir Hamzah. The minister also stressed that the restructuring of EPF accounts is aimed at improving the security of retirement income and giving members access to the flexible account at any time and for any purpose, especially for emergencies. Prudential has emerged as a substantial shareholder at Penang-based automated test equipment maker TT Vision Holdings after acquiring 293,600 shares. According to a boss filing on July 23rd, this raised Prudential's total stake in the company to 5.04%, held under funds managed by Eastspring Investments. TT Vision's other substantial shareholders include CEO Gun Kun Yin and COO Wong Yi Xiao. Meanwhile, Phillip Capital has maintained its buy rating on TT Vision at 1 ringgit and 6 cents with an unchanged target price of 1 ringgit 50 and expects the company to report higher sequential earnings in its upcoming results for the second quarter, driven by increased order deliveries and a robust order backlog. In a note on Thursday, Research House said TT Vision had secured about 10 million in new orders in the second quarter across the solar, optoelectronics and semiconductor segments. KIP Real Estate Investment Trust saw its net property income surge 63% year-on-year in the fourth quarter from 16.2 million to 26.4 million, thanks to strong gain of retail properties in the northern and central regions. Revenue rose 46% year-on-year to 32.6 million ringgit. Income distributable to unit holders, however, was 28% higher at 13.5 million, while distribution per unit was 1.97 sen versus 1.75 sen in the fourth quarter of FY 2023. KIP REIT's portfolio comprised 8 retail malls in southern, central and northern regions of Malaysia, as well as 3 industrial properties. All in all, the 11 assets are worth 1.05 billion as at end June. CEO Valerie Ong Pui Shan says that it is excited by the potential of its existing assets and the vast opportunities to acquire high-quality accretive assets with strong recurring rental income to expand its portfolio. KIP REIT is in the midst of completing the previously announced acquisition of Pulse Shopping Centre, its 9th retail asset. If successful, the 320 million deal would be its largest acquisition since its listing in 2017. Ong says the trust is well on its way to achieving its goal of reaching 2 billion in assets under management within the next 3 years. For FY 2024, net property income totaled 77.82 million compared to 62.15 million over the same period last year. Comprehensive income was down 22% to 47.3 million ringgit. Plastic material and resin manufacturer Luxchem Corp's net profit for the second quarter jumped 30% year-on-year to 12.2 million, thanks to higher contributions from both trading and manufacturing activities. Likewise, revenue for the quarter rose 33% year-on-year to 210.2 million from 157.6 million ringgit. Luxchem also declared a single-tier interim dividend of 0.8 sen per share. For the first half, the group's net profit rose 40% to 23.8 million from 16.9 million, buoyed by both the trading and manufacturing segments, while revenue grew 27% year-on-year to 393.3 million ringgit. On its outlook, Luxchem said it will continue to improve its productivity and efficiency to face external uncontrollable factors and challenges. The company flagged key challenges such as exchange rates, raw material price fluctuations, raw material demand and supply situations, stiff competition and ongoing geopolitical conflicts.